Hey, welcome to Private Money Club's Money Clubs Mondays weekly webinar, 1 p.m. Eastern. Today's November 14th, 2022. And today we're going to be talking private money. So what I mean by that is, what is private money and how can you take advantage of it, whether you are borrowing it, whether you're lending it, and what does that look like? How do you set that up? What are the options? What are the different types of private money loans that are out there? And what can you expect from not only Private Money Club, but Money School and myself and Chris Noggle moving forward. So welcome today, and let's go ahead and dive into this. All right. So today I want to make it an open discussion. So please, interact with me on the chat box if you guys don't mind. I'm going to draw some stuff on the whiteboard, but today is all about private money. And please, if anybody has any questions, like if you guys are lending, borrowing, if you're running into anything, please let me know so we can go over that stuff. So first up, private money. What does private money mean to you? Private money to me means control. So I have the ability to control my money, whether I'm borrowing or lending. So let's just break this out. You have lenders and you have borrowers. So lenders are people with the money. Borrowers are the people that need the money. Okay, so let's think about a couple of reasons why somebody would need private money. All right. And again, private money is money coming from an individual, people like you, people like me, people like our families, just individual people. All right. So private. So where could that money come from? Again, if you were on this weekend, this is kind of just a review from this weekend. So where would the private money come from? So cash sitting in a bank account, sitting in a savings account, something like that. It can be retirement funds, so IRA, 401k, etc., that kind of thing. So retirement funds. Retirement funds are also known as qualified. Okay, they're known as qualified funds. All right. So there's so 1, 2, all right, 3. Where else could private money come from? Morgan said IBC, absolutely. So a whole life, IBC, whole life policy. Okay, maybe you're running money through a whole life policy first, and then once the money's in there, now you're looking to grow your wealth by doing things like lending it out. Absolutely, I love it. And then Morgan also said HELOCs and HELOCs. All right, awesome, perfect. So a home equity line of credit or a home equity loan agreement, but either way, you're tapping into equity of property that you own. There's other ways to leverage money. You can leverage brokerage accounts. You can leverage crypto accounts. You can leverage precious metal accounts. I work with some people that, they buy a lot of precious metals and then they actually borrow against those precious metals and use those precious metals as collateral, just like we do with the infinite banking concept. So, there's other ways to do that also, but anything where you're leveraging or some kind of line of credit that you're able to access and use the money, absolutely. So this is all private money. So, and when we look at retirement funds, you're going to have what's called a self-directed IRA, which is what we'll teach tomorrow evening. If you're unfamiliar with that, join us tomorrow at 6 p.m. Eastern to learn more about self-directed, but it's using retirement funds to do this sort of thing. All right, so these are all the different, these are the primary sources of where people have money and things that you can look at using to lend and grow your wealth further. Okay, so that's on the lender side of things. Now, that's true private money, right? So not to be confused with, so you'll hear hard money loans a lot of the time. Hard money loans, typically speaking, are more institutional money, like hedge funds. So, a big organization, a hedge fund, an investment firm will have, millions of dollars of clients' money, and they're looking to lend that money out and grow their clients' money. Now, typically with hard money, strict qualifications and strict terms. So with hard money, they might say, okay, you need a 650 credit score. You got to have a certain loan to value, kind of like a bank does. It's a lot easier and faster than a traditional bank loan, but so it's good in that sense. They'll lend to you. There's even asset-based hard money lenders where, they don't care about your credit card or you personal. They'll look at the deal. But in that case, if they scratch on the qualification, a lot of times the terms are not going to be as favorable for you as the borrower. So they're going to charge a lot more if they get rid of the qualifications. If they have stricter qualifications, then the terms might be a little bit better, but then you're trading one for the other. And usually they're not negotiable. So they tell you, listen, we're willing to lend you this amount for this term, no matter what. A lot of times points are involved. If you only need the money for 3 to 6 months for a flip, they might say, listen, we're going to lend it to you for 1 year. If you pay us back early, you're still going to pay for the whole year, or there's prepayment penalties. So there's going to be a lot more guidelines and restrictions typically with hard money. So that's the biggest difference. With private money, because it's people like me, like you, it simply means that it's all negotiable. I can look at a deal that let's say Morgan has on here and say, okay, I'm willing to lend to Morgan at 12%, no points, 3 months, right there, boom. I don't care about anything else. I'm doing the deal. It's my choice. It's private money. Or in somebody else, I might say, well, I want 15% and 3 points and I want a year or whatever it is. You know what I mean? So it's truly negotiable when it comes to the private money. So if you're a borrower, and then of course you have traditional loans. Traditional loans would be like from a bank, like a traditional bank loan, okay? Like a normal mortgage or a construction loan or something of that nature. And of course, those are going to be the most strict qualifications and definitely not negotiable. And you're dealing with the banks, which a lot of people don't like that. Banks treat you kind of as a number, not as a person. One of the cool things about borrowing and lending private money is you see the smile on that borrower's face. I mean, when I lend somebody money, it puts a huge smile on their face, because what do they get to do with that money now? Now they get to go make their dreams come true, because without your money, they would never be able to buy and rehab that house and make $50,000, $60,000 on that flip, which for a lot of investors is life-changing money, or whatever that looks like for them. So you're able to really make people happy, and vice versa. I mean, if you're looking at, right now you're losing a ton of money in the stock market, you pull that money out of your old 401k and move it into a self-directed IRA, and now you're lending money making 12, 15% consistent, predictable returns. Well, you got a big smile on your face too, because you're making money that's secured by real estate, while everybody else that is losing money in the stock market. So it creates these win-win situations where everybody gets a smile on their face. Again, hard money, same thing. It's hedge funds, like you're treated like a number in most cases. I know some good hard money lenders, but it's far and few between, really, to tell you the truth, especially these days. Why would a borrower need private money as opposed to traditional money? Because remember, not only just the feel good part of it, but this is still business, right? I mean, a traditional loan, let's just say you can get a 6% right now. A private loan is going to be, say, let's 12%. So why is somebody willing to pay double for the same loan if they're able to qualify for both? Well, the number of reasons. One could be speed. One could be the rest of the terms. So just because the money's cheaper doesn't mean that it's going to work for whatever the deal is that they need. Maybe they only need the money again for 6 months or 5 years or whatever it is. Like, the private money can be negotiable. Maybe this traditional loan, they don't offer that type of loan that you need. So there's a number of reasons, again, why somebody would go to private money. And if you've ever heard like Rob Fuller speak and his wife, Nicole, they have a very good way of why they decided to work with Private Money Club over hard money. They had millions of dollars they were paying less for hard money, but they've now raised almost $40 million, over $20 million through Private Money Club, paying more than what the hard money was, but it works for what they're doing with their projects. So for them, the ease of it and the way that they're able to get the money and put that money to work, it works a lot better using private money than traditional or hard money. And they do a very good job of explaining that. And they'll be joining us. I believe they're going to join us Thursday also for a little bit on that group coaching call on Thursday. So make sure you hop on and check that out on Thursday as well. All right. So now let's talk about deals. And let's look at this from a lender point of view, okay? So if you're a borrower, one of the nice things about the Private Money Club is, and you'll see this in a second when I show some of the different deals on here, is it allows you to structure deals multiple different ways to fit whatever your business model happens to be. What I mean by that are, people are doing flips, for example. All right. So let's just talk about a flip for a minute. So when it comes to a flip, you have the purchase price. Okay, so first up, you have the purchase price. And then you have the rehab cost. You have holding costs. And then let's say you have closing costs, right? So those are essentially the 4 different expenses that are involved when it comes to a flip. I don't think I'm missing anything, am I? And I'll kind of explain each one of these. So as a borrower, when I have a flip, let's just say purchase price is $100,000, the rehab is $50,000. Okay, so those costs are easy to figure out. The purchase price is how much you're buying the property for. The rehab cost is how much it's going to cost you in time and material and everything to fix the house up, to flip it, to repair the home, to rehab it. The holding costs are going to be things like insurance. When you purchase a house, even if you're flipping it, you now own that property. Well, you need to insure that property, because what if you have a contractor on property and they leave a electrical cord plugged in with a loose end to it and it starts a fire and the whole place burns down, or you're in the middle of it and a hurricane comes and wipes it out, or you have a nosy neighbor that's going and they get on the property and they're looking around and they hurt themselves and they sue you or whatever. There's a million things that can go wrong. So you do need to cover insurance. So the holding costs would be things like insurance, taxes. Again, if you're doing a flip and you own the property for 6 months, when you buy it till you sell it, you're going to pay 6 months worth of taxes. Insurance, taxes, you have interest. If you're borrowing the money to do this flip, you're borrowing private money, you're going to be paying monthly interest in most cases. So that's a holding cost that's involved. The utilities. Yeah, Morgan, absolutely. So you have water, you have electric, you have, possibly depending on where you are, gas bills, things like that. So those holding costs are vary, but as a borrower, you need to know every one of these costs down to the dollar. As a lender, when I'm evaluating a deal, this is the stuff that I'm looking at. If I'm looking at a deal and the borrower forgot to include the holding costs, well, that's telling me that borrower might not know what they're doing, and I might not want to lend to that person because they're forgetting things. And if they're forgetting things that are costing them money in this deal, then at the end of the deal, they might think that they have a great profit and can pay you back everything. But what happens when they lose money? And then maybe forgot to look at their personal financials. So they don't have the money to pay you back. What's that look like? So these are all things that are important to know about when we're looking at lending money. And then the closing costs. So those are like realtor fees. Most successful flippers I know stage their homes when they sell them. Staging, realtor fees, again, any taxes or any kind of, depending on where you are, the buyer or the seller, depends on who pays different things like the prorated taxes and prorated utilities for that month. But that all goes into the closing statements. Depending on where you are, those could be all closing costs. But, the marketing or the realtor fees and the staging would probably be some of the highest costs that would be involved with the closing, unless you're paying closing. It depends on who's paying the closing agent. Again, what city, every state is different. Every county is different. Towns can be different. That's a very local thing. So know what know where you are, make sure you're reading the contracts and all this stuff is disclosed and you know exactly what's going on with it. So as a lender on the private money club, what we can do is we can start taking advantage of different tools. So let me just share my screen here. If we go to, for example, I think it's the Learn section. Can I access this right now? Let me see. I know we're in the middle of changing all this, so I just don't know what they've gone through. Okay, so it's still on here right now. So this is what, if I was lending to somebody, this is what I'm usually going to ask them for, is this perfect loan proposal. And most borrowers that are on Private Money Club are putting these together. So we have what's called the property lead sheet, and then we have what's called the loan proposal template. So let's walk through both these real fast. And then you can watch this video if you want to learn a little bit more in depth on it. So this is what we call the property spec sheet. So this is going to show you like all the numbers, the details about the property, everything that's going on with it. And again, what I showed you on the screen behind me a second ago are the basics, are the general overview of what this thing gets into the specifics of. So you can see right here, 145,000 purchase price, some property features, nice and pretty. And then we start getting into it. So you have property information. So this is what this thing will look like. So if you have if you're looking to lend on a deal, this is the kind of stuff you're going to want to know. So property taxes and fees. It breaks it all down. So you can break it out yearly, monthly. You can prorate stuff. All the holding carrying costs, like I was just talking about, lawn maintenance, utilities, snow removal. If you're up north, I always forget about the snow when I'm living here in Florida, but estimated closing costs, like I was talking about, attorney's fees, commissions, all that good stuff. Depending on where you are, total project costs, so project purchase, You can bring over the closing costs, the scope of work, which will be below, the loan price again. So if you're making loan payments, how much those. So this just makes sure you're not forgetting anything that I just went over on the whiteboard behind me a second ago. This will break down the scope of work. So what is going on? How much is it going to cost? So we can add all that up. Any pictures, I would recommend, so that way you can see, well, this is what the property looks like now. You say, hey, they're putting $25,000 into the kitchen. That kitchen looks like it's probably going to need $50,000 worth. Are they looking at that right? So the pictures are good just to get a feeling for, what that property looks like. So as a borrower, we have all these templates made for you. All you got to do is go in and input your information. And if you're doing the deal right, you have all this already anyways. And then this last page is just a little recap of what you're looking to do. How much is the interest? How's it paid? How long is it? Is it first lien position? What's that look like? So everything about the deal, how much you're going to get back, the expected time frame. So that just kind of recaps the whole thing. So this is what we call the deal spec sheet. That's used within the private money club in most scenarios. And then you have the actual perfect loan proposal, which I'll go through that real fast as well. So we have the perfect loan proposal, which gets into a little bit more depth. So you can see in the table of contents here. So we're going to have a credibility piece, which talks about you. The section one's all about you. So who are you? Who's your team? What are deals that you've done? We're going to get into your finances. So your personal financial statement, known as a PFS. So why would you want to know someone's personal finances? Well, if I'm lending you $150,000, even if it's backed by real estate, what if the deal goes bad or something? Can you still pay me back? Like, do you have money in the bank? Have you financially been responsible in the past? And if I have somebody that I know has $1 million in the bank and can pay me back very easily, or owns a bunch of other assets that they could tap into to pay me back if they can't pay me on this deal, if I have a personal guarantee on it, I want to know that they can actually pay me back if I have that personal guarantee. So that's why I'm looking into that stuff. So somebody that I'm lending to that's in a good financial situation, hey, that's a lot to me as a lender. That looks like less risk. So I'm willing to maybe lend them money at 10%, let's say, where I have somebody over on this hand that they're brand new. They've never done a real estate deal. They don't have much money. That's the reason they need private money, is because they don't have any other access to any money. They don't have any equity anywhere. They don't have any assets anywhere. If this deal goes bad, they're not paying me back. Like, I'm going to be forced to foreclose on it, put the money out, deal with all that, which in the long run's fine for me, but is it worth it? So to me, that sounds like more risk, which means I want more reward on my risk, which means I want more returns. So instead of 10%, I'm going to offer this guy, for you on this deal, I'm going to charge you 15% plus 2 points, because I have a feeling I might have to end up helping you on the deal because you're brand new at all of it. So I want to get paid for that. Or I want 15% returns annual with monthly interest. I want, $5,000 on the back end also once you sell it, or whatever, maybe I do something like that. But again, that's private money. This is all a negotiation. I'm just telling you what goes through my mind when I'm looking at this stuff, and why, as a lender, I want to look at this from you as the borrower, at least until we have this relationship built. Now, once I lend to you several times, I know who you are. I don't need to look at a perfect loan proposal anymore. I know who you are. Now we have a relationship built. Now we're just doing deals back and forth like we're friends. But at the beginning, to me, this is very important stuff right here. Freddie said, what kind of documents can we get for a personal guarantee? So that would be the promissory note, the contract, or the mortgage even. It just needs to be done correctly, but it basically just is a personal guarantee saying, if the deal goes bad, there's recourse. A non-recourse loan means they can't come after you personally. It's the property only. On a typical mortgage, if there's any kind of personal guarantee, it says if the deal goes bad, they will make you whole from funds outside of the deal itself, from them personally, from their savings, from whatever that might look like. And if they don't, you can come after them personally. So not only after the deal that you're lending on, but after all of their other assets, after them themselves. So you just have to make sure that's written up right in a contract, Freddie, but that's all it is. Aaron said, will the perfect loan proposal still be on the site as a template once the updates to the site are finished? Yeah, we'll still have the perfect loan proposal, Aaron. We just can't require people to use it. But it's still a great resource and tool for borrowers and lenders to use. So definitely. You can see, we even, say recommend put your 3 years of tax returns in there. Now, if you're a borrower and you're looking at this and you're like, well, I don't really have this right now. I don't want to pull a credit report right now. I'm not saying you have to do all this. I'm just saying that this might be something that if you're building a new relationship that the lender might want from you. So if you already have it all together, I mean, how much better does that look? Like if I post a deal on Private Money Club and then Aaron reaches out to me and says, hey, I'm interested in your deal. Can you send me your personal financial statement? Can you send me a little bit more about yourself? Can you send me the info about the deal, more specifics about the breakdown of it? Like the pictures look good. I understand what you're looking for, but can you send me more specifics? And then within 30 seconds, you just reply back with this perfect loan proposal ready to go. I mean, me as a lender, I'm gonna be like, hell, this guy knows what they're doing. Like, I'm gonna lend to them because they're on it. Where, if I ask you for that stuff and then you as a borrower are like, well, give me a week. I got to pull together my stuff, my info. I got to make sure that my numbers are right. I don't really know what my credit score is right now. Maybe I can do that for you later on. Me as a lender, I'm like, whatever, I'm moving on to the next deal. Like time is money. If my money's sitting still, I'm losing money. So I'm not going to wait for you to dilly daddle and get this together. I want to do business with you. If you don't want to do business with me, then what's the point of this? So if I was a borrower, again, I would have all this stuff ready to go. Just in case, because if somebody wants your deal, be ready for it. And then the second half of this is the deal spec sheet I just showed you, the comps, that support your purchase price and after rehab cost and or after rehab value. Even if you have an appraisal, that's even better. The scope of work, everything like that. So very easy. You can just plug and play about you and your company. Who's your leadership in your company? What's your mission statement? Do you have any CEO? Do you have a CEO? Do you have an acquisitions manager? Do you have a construction manager? Do you have a general contractor? Do you have realtors? Do you have a marketing team? Do you have a call center? What does that look like? Like, what's your team look like? Is it just you? It's fine if it's just you, but explain what your experience is. Again, if your company's new, no big deal. Just put that in there. So we try and use this to kind of prompt borrowers to share what a lender will be looking for, and we try and prompt lenders to use this to help them know what to ask borrowers for. Again, you don't need any of this stuff, but it's your comfort level. Are you comfortable lending to somebody without this, or would you be more comfortable lending to somebody with this? If you don't need it, then lend to them. It doesn't matter. You don't need this stuff. This is just all things that can help in your private money journey, whether you're a borrower or a lender. So if we're looking for flips, we could say, okay, so single family flip with great spreads. So this is what this would kind of look like in real life. We're looking for a flip. So this is a rental backed micro loan. So that's not what I would want to be lending on. I'm looking for a flip, right? So those would not be deals I want. Here's one, fix and flip. Oh, so there's another one, but here's this one first. So let's see here. So this address, so it has the address of the property. It's in Indiana. So they have it under contract right now for $55,000. I get all my deals off market. So he's saying how he purchases his deals. Right now it's tenant occupied. They have permission to give the tenants 30 days notice so they can move. General contractors walked it, sending a formal estimate. So right now they're ballparking $35,000 in rehab work. And it sounds like he'll have a formal estimate that he can put onto that deal spec sheet or send you over his version of the deal spec sheet any day now. So this might be one where I'm like, okay, this is interesting to me. I want to know more details. So ARV, so he has some comps. So a 3-1 on a property 2 streets over for 170. We're going to make it look better with higher end finishes. I think with the market downturn, I'm expecting somewhere between. So that's good. So he knows that another one just sold. They're going to make theirs nicer, but they're still planning on selling it for less because of the downturn in the market right now. So that's good. I mean, he's putting that right out there. The more honesty, the more upfront that somebody is to me, the better. A lot of videos, so he can send you videos with commentary. And yeah, you can't upload those to PMC right now, so he can send you those videos if you were interested. Get the map of the property right there. He's got an inspection report right on the site, so I can download that. Let's take a quick little glance at it while we have it. All right, so this is good. So instead of, so he actually has a full inspection on this, which is great. So no hidden, not only does he have a contractor looking at the rehab, but now he's got a full inspection to know exactly what he's getting into to make sure that he's not missing any, leaks in walls or things that, a contractor might skip over. So if on this deal, I wanted to find more, he's got a couple pictures. Like you said, he does a lot of videos, so he can send you the videos. So in this case, it's all right that he only has a few videos, pictures on here because he does say, hey, I got video. So in this case, you say, hey, I'm interested. Maybe you want to see the proposal. Hey, I want to see the proposal. Please send the detailed general contractor report or deal spec sheet. You have personal financial statement. What's your experience? Stuff like that. Can we call? Send me the videos. Can we set up a Zoom to talk more? And on here, I'm a big fan of Zooms. Instead of a phone calls are fine if you prefer the phone, but it's something about seeing somebody and actually being able to see them in person. And, obviously I'm not going to fly to Indiana for this, but in person to me these days is Zoom. So why not see the person, talk with them? You can feel somebody out. I mean, so much of communication is nonverbal, right? So if we can do Zoom this day and age for free, why not? So I'm not going to send this, but if I sent this, it would open up a new message where we can start talking to each other. And then if we enter into that deal together, then it's going to pop up a checklist. So it'll have a checklist of every step that needs to be completed between me and Bo to do this deal the right way. So that's what that would look like if I was looking to lend on that deal. Maybe I don't like that deal. All right, we don't want to do a rental back loan. We want to do another fix and flip. Okay, here's another fix and flip. New opportunity offering 12%. Dwight and Brandon, I believe. Yes, so Dwight, Harrison, and Brandon. So, hey, these are friends of mine. I know them. In this case, I just say, hey, I'm interested. Let's do the deal. Please send me the paperwork. Why would I do that for Dwight? Because I know him. Because I know the deal that he's offering me is going to be good. Now I'm gonna double check it. Trust me, but I'm just saying, like, send me the paperwork. Let's get this thing going. So that's that. I mean, pretty simple. And again, first position, fix and flip, short term, looks good. So those are just some different, depending on what we're looking for. That of course on Private Money Club right now, there's smaller deals, there's long-term deals. These are all individuals. It looks like on here. So Morgan said, I share videos on property via Google Photos. It lets you create a link. We can post a link in our listing. I don't know if you can put a link on the Private Money Club listing right now, Morgan, but you could say, I have a link to videos and photos, message me and I'll send it right to you, and then just send it right to them. So if it doesn't let you post a URL in there right now, a hyperlink, I don't know. You can try. So those are kind of like Private Money Club deals, right? Flips, you saw the rentals. There's short term, which are going to be like the flips. There's long term. Some of these rental deals, some of the things that Dwight are doing, Steve Lawson are doing, a bunch of people actually on there are doing some longer term stuff as well. You got a lot of different options here. You can do first lien position, second lien position. So those are going to be the primarily what's on Private Money Club right now. But that's all that's on Private Money Club right now, I should say. All right. So the way that this looks on Private Money Club, so it's either going to be first position or second position. First position means you have the first right. If they don't oblige by the mortgage and the contract, you can foreclose on it, or you can take over the property. However the contract is worded, you have the first right of that. Second lien position means after the first lien position gets their money back, then the second lien would get any of the money that's left over after that to recoup your money. It just means that the first gets theirs first, you get your second if there's anything left over. If there's nothing left over after the first, then you can lose out. So when you do any loan, whether it's first or second lien position, you just need to make sure that there's enough equity in the deal, enough money in the deal, where if things go bad, you're going to have enough money to get paid out on it. Okay. So never, ever, ever lend to an individual. In most states, you can lend as an individual. Although I'm just learning that you can only lend from an LLC in Florida, which was news to me. So you learn something new every day, but that's why we're doing this. And that's why some of the states are not legal yet on Private Money Club as well. So we have 17 states right now that you cannot post deals on. However, you can still lend from those states. We just can't post deals on the site yet. But these are all legal things that we're overcoming right now because we want to do things legal. And one of those legal things is you never lend to an individual. There's Dodd-Frank laws. So anytime you lend to somebody, you need to lend to a company. You're never going to send the money directly to that person. You always want to run it through an escrow company or an attorney's office first. Just to make sure it's protected, the contract and everything is done right, and then they'll release the money to the company. So little things like that. And that's what Private Money Club is right now. Individuals with these types of deals that are looking for your money and all those different sources that you can lend to them. The terms are negotiable, the interest rates, the length, all that stuff. So that's Private Money Club in a nutshell. There's a couple other ways to lend money, and there's a couple other different types of real estate deals that you can be involved in when it comes to private money. So I just wanted to hit those, like I was saying before, just so we're all on the same page. And if you start to hear this kind of stuff when you're out there, out and about, you'll know the differences and you'll know what you're talking about. So Ruth, I'll talk a little bit about funds here, okay? So there's really two other types of deals when it comes to this kind of private investing, especially in the real estate world. You're going to hear syndications quite often. So a syndication is typically going to be syndications usually are for a specific property. Okay. So in this example, let's say it's a 150 unit apartment complex. So they're typically going to be for a specific project. So in this case, we'll just use a 150 unit apartment complex as an example here. All right. So in a syndication, you're typically going to have two different types of partners that are involved with the syndication. All right. So you have the general partners who put the deal together essentially. So they're going to be the active managing partners. So they're the ones that are actively putting the syndication together, raising the money, finding the deal that the syndication's on, doing all the work. So let's say it's a 150 unit apartment complex, value raise, and this is a very common type of syndication. So the general partners are in charge of everything, the work to purchase it, the rehab work, the repair, driving the value of the property up, restructuring it all. A lot of times moving old tenants out, moving new tenants in, raising rents, everything that they do for a value raise apartment complex deal like this. And then you have limited partners. The limited partners are passive. So they basically are providing the money and they're sitting back and waiting. They're not involved with decisions. They're not involved in day-to-day operations. They're just on the money side. Now, the general partners often will put their own money into the deal also. So they both can have a financial interest in it, but the general partners actively manage. The limited partners are just completely passive. They're not involved in it whatsoever. So some of the advantages to a syndication is you have ownership in the deal. So often you can have some advantages on that side, possibly tax advantages, things of that nature. Also profits or losses. So if the syndication makes money, whenever you enter it as a limited partner, hey, you get X amount of profit, from the deal once we sell it or once we refinance it, whatever the case that might be. Or if there's losses, then you share in those losses either way. So you have the ownership and then you have a direct share of profits or losses, depending on what that looks like. Oftentimes with the syndication, especially when they refi it, the passive investor might get a certain interest rate. Maybe they get 10% for 3 years. And then they say in 3 years, we're going to refinance this thing. And then after the refinance, so let's just say you have $100,000 in it. So $100,000, you're going to earn 10% annually for 3 years. At the end of the 3 years, upon the refi, you're going to get your $100,000 back. And then at that point, they'll say, okay, now you're in the deal for 2% ongoing revenue. So you made 10%, and then moving forward after those 3 years, you get your money back, but you're still receiving 2% of whatever that ongoing revenue of monthly income from the 150 unit apartment complex is. So a lot of times that amount will drop or whatever that looks like. So a lot of times you'll have something up front, and then depending on whatever the exit strategy is or the plan on that, you'll have something ongoing. Now, if they decide to sell, then maybe you get a profit on the sale and whatever percentage that is, whatever percentage profit that might be, depending on the terms of that syndication. So those are so it's a little bit more involved, than like a private fund, for example. There's pros and cons. The biggest thing when it comes to syndications are the general partners. The general partners of syndications play a huge deal because they're the ones who literally are in charge of every aspect of it. And so if they know what they're doing, great. If they don't know what they're doing, you're going to be in a world of trouble. And a lot of people think that this is an easy thing to do. And a lot of general partners start these syndications. And I've seen a lot of syndications fail. And people just get into a lot of trouble. And I've seen people lose money in them. And so just be careful with syndications. Syndications are not allowed in Private Money Club right now, just so you guys know. Neither are private funds. That's why I said Private Money Club is strictly direct lending, like we just talked about. Syndications of private funds are not allowed in private money club. But nonetheless, that's what a syndication is. So people like Chris Bizub, he's in our inner circle, comes to our masterminds, part of Money School, part of Money Multiplier, part of Private Money Club. He can't post his syndications in Private Money Club though, because it's not allowed right now. But that's that's what Chris Bizub does, is he does syndications. He's a general partner, and they're looking for limited partners, people that can invest. And you know, Chris, he's introduced me to a couple of his partners, and I think they're doing a good job with it. But again, it goes back to, you know, you got to trust. It's the relationship, just like in the direct private money lending, same thing. And then a private fund is what you hear us talk about a lot. So private funds, the last two private funds that we've had, actually that are active right now. So you have CapFlow and you have Inicio. So let me just talk about those real fast. So just to give you a couple examples here. So when it comes to a private fund, what happens is you have the owners, you have the partners that own the private fund. And what that fund is doing is it's literally a fund. It's a pool of money. So, you know, so what happens is you have people that are lending private money, but instead of lending it to a specific deal, they're lending it to a fund that has the ability to invest in multiple different deals. So private fund is multiple deals. So all this money that is raised within this private fund then uses that money to lend on deals that it finds appropriate to lend on. So basically the private fund almost basically becomes a bank where it's deciding, its partners are deciding on which deals to lend on that they find will be profitable for the fund. And then the fund pays out the investors whatever the agreed upon terms are, which I'll show you in a second, whatever the agreed upon terms are. And then the fund basically partners keep any of the additional profits that are involved. These private funds are very expensive to register, typically about $100,000. So a lot of times you'll see them longer term, larger amounts of money, things like that. So just to give you a couple examples, CapFlow, 6 to 10%, depending on if you want to invest for 1 to 3 years. So on CapFlow, it's very simple. If I want to invest for 1 year, if I want to lock in my money for 1 year and get my money back in 1 year, I'm going to receive 6% annual returns and interest paid monthly. If I'm going to put my money in for 2 years, I believe it's 8%, 7 or 8%. This is Andrew and Chris. So if anybody wants to talk about CapFlow, let me know. I'll connect you with Andrew. And then 3 years, I believe, is 9 or 10%. So if you say, hey, I'll give you my money for 3 years, then for the next 3 years, your money's going to grow at 9 or 10%, whatever it is, interest paid to you monthly. And at the end of the 3 years, you get your money back. It's nice and clean. It's nice and easy. It's actually a direct loan too. So there's no ownership involved. There's no complexity there. It's just you're lending the money and then you're getting it back. Now, your money is secured. It's not really secured directly by these deals, but it's secured by the fund, which is secured by these deals. So the fund actually has the security, and then your money is secured by the fund. So that's the way that works. Inicio is the same way. It's just on Inicio, what we've done is we said, okay, we're going to pay a 4% annual return, a 4% preferred return on your money. That interest is only paid quarterly. But so this one is not for somebody that's looking for like that consistent, decent return. This fund would be for somebody that is looking to kind of get much higher returns on their money, because this fund, it's not a syndication, it's direct lending. So it gets rid of all the complexity of all of that. And it's for multiple deals. It's not one single deal. We're going to be doing lots of high profit deals with this Inicio fund. And I am a partner in this fund, so I can talk specifically about this one with you guys. And if you have any questions, I'm happy to hop on a phone or send you over the brochure or any more information on it. I am a partner in this with Chris and Greg and Kent and a few other guys, Justin and a few other guys. So just know that, but 4% annual return. But then you also get 70, 80% of profits, which we're looking at around 16 to 19% annually. So you're going to get the preferred return, but you're also going to get a payout once a year of what we're aiming for of about 16 to 19% to pay you out on that interest. So that one's for if you're looking to get a little bit more, but by no means guaranteed. It's just using our experience in this kind of market to buy the right types of deals where we can go out there and make a bunch of money with this Inicio fund in this market that we're in right now. So that was the point of this one. It just launched a couple of weeks ago. It's brand new. We're raising money for 6 months and then it's done for 5 years. just so you know. So that's this fund. So these are private funds. So they're very clean. They're simple. The paperwork's easy. You do need to be an accredited investor. It's self-reported. So if you're an accredited investor, then you would be able to hop on that, and we can talk more about that later. All right. So those are just some different types of ways to lend money privately, different types of ways to raise money privately. But I hope that a lot of that made sense to you guys. And it's 2:01, and I actually have another meeting to hop on with the developers of Private Money Club, so we can start working on all of the new features that are coming and making sure that those are in the works. So I'm going to hop off here. Let me see. David said, how many months or years is the contract on the 2% on gains with the syndication? Usually, well, Dave, I was just giving you an example, David, of a syndication. Every deal is going to be different. That syndication, what they're paying out on it, or what that looks like for the limited partner. I would just say a lot of times that happens, but when that does happen on the back end like that, usually it's for the existence of the property. So if if they own that property for 30 years, you're going to get paid out for 30 years. If they sell the thing in 2 years, then you're cashed out of it and you're moving on to the next one. So it just depends on the deal. Minimum for Inicio is 25,000 minimum for Inicio. Morgan said, is Chris's syndication in real estate? Yeah, that's all BizHub does, is 100% syndications in real estate, Morgan. Syndications being used other than real estate. Well, I'm personally not experienced in raising money outside of real estate, Morgan. So I don't know if it's called a syndication. I think that's more just crowdfunding or crowdsourcing, like you see on some of those different crowdsourcing websites where they're raising money for companies. The way you raise money for companies is a little bit different than real estate. So I don't know if that would be considered a syndication or what, but specifically I'm talking about real estate though. Chris Ash, you do need to be an accredited investor. It's self-reported. You might be accredited and don't even realize it. So happy to kind of talk with you through that on the phone. If you guys want to set up a call, or just send me an email or a text and I can just call you real fast. We can talk for like 5 minutes. It doesn't have to be a full long call. So if anybody wants to chat or wants more info, just email me, or I'll put my cell in here if you want to text me. All right, that's all the questions I see. So I hope everybody has a great day. Like I said, we got a bunch of good webinars this week, so make sure you hop on. If you need anything, give me a shout. But have a great day. We'll talk to you guys soon. Thank you.